Business of Property podcast. I'm Simon, and I've been investing in property for over 20 years. And if you're an active landlord or planning your next property investment, this podcast is for you. In the last couple of months, I've seen quite a few landlords mention moving existing rental properties into a limited company. Now, why would they do this? Well, that's what today's episode is all about. And I think the most likely key is Section 24. Before I explain that though, I will just acknowledge that people may look at moving properties into a limited company for other reasons. Maybe related to inheritance planning or redirecting income between groups of people, or most commonly other attempts to sort of mitigate or move around certain types of tax liability. There are also other reasons around sort of trying to professionalize what they're doing, or perhaps also diversifying what they're doing with property. That may also be reasons for trying to have your property in a limited company instead. But today, I'm focusing on issues with sort of current cash flow. And these are the ones that are most likely to be caused by Section 24. So what is Section 24? Well, it was a taxation change brought in by a Conservative government many years ago now, and it has been in full effect for quite a few years as well. However, early on, lots of landlords probably didn't notice that much of a change because mortgage interest rates were very low. And as people have now been remortgaging onto much higher rates, that Section 24 change has become a lot more noticeable. The change in Section 24, or rather the change that was introduced by Section 24, means that finance costs, most commonly mortgage interest, doesn't count as an expense for tax purposes in property rental businesses. So when calculating the tax you owe on personally owned rental property, you add up all your rent, then subtract your running expenses, but not your mortgage interest. And that's what you use to work out how much tax you owe, roughly speaking. So you might have, say, £12,000 of rent, £1,000 a month, and you might have £2,000 of expenses for agents and minor repairs and the like throughout the year. And that leaves you with £10,000 of income. And that counts towards your taxable income, the whole £10,000 of it. And that probably means you'll be paying 20% or 40% or what have you of that £10,000 as part of your tax bill. The trouble is that you don't actually have £10,000 to pay the tax from, because you actually also had a mortgage, which means you had mortgage payments and mortgage interest on that loan. And because you are making those payments, that's actually reduced the amount of money you really have. So 5 years ago or more, you might have been paying maybe £3,000 a year on a mortgage on a property that might generate £1,000 of rent. Now that £3,000 that you couldn't take off your £10,000 of income before working out your tax, it's enough to notice, but it's probably not enough to sort of break the bank, if you like. But now you're probably paying closer to £7,500 for your mortgage each year. And once you take £7,500 off £10,000, and then you take £4,000 off for the 40% tax you might be paying, you can see that things don't work out quite so well anymore. And they're certainly a lot more noticeable. Now, this is just a very quick example. The calculations aren't quite that simple. There's actually a 20% tax credit to factor in as well, which counts against the mortgage payments. But for today, the important thing to note is that Section 24, combined with the higher mortgage interest rates that we now have, mean a lot of existing landlords are finding their investment properties don't actually produce cash flow anymore, or at least not cash flow that's particularly worthwhile anymore. Now, Section 24 doesn't apply to property owned by a limited company. So one possible solution to this situation is to move your property from personal names into a limited company. Now, I've described this as moving a couple of times, but that isn't really a thing. Any company you own and you yourself are completely different entities. So to move a property, you actually have to sell it to your company. This means all the normal things a sale and a purchase would. You do get to avoid any agent fees because you already have a buyer, so you don't need an agent to help you find one of those. But for everything else, you'll still be paying out what you would expect in the process of selling and buying. So on the selling side, that probably includes solicitor fees, any mortgage redemption fees, although you can probably time things to avoid the worst of them. There will almost certainly be some cost involved in that. And probably a big one is any capital gains tax. This will also always be at market value, it's worth noting. So you can't just sell your property for £1 and think, oh, well, there's no capital gains tax now because I haven't made a capital gain. It won't work. You can't get away with that, unfortunately. And you aren't just selling. You're also buying, or at least your company is buying. This means another set of solicitor fees. Stamp duty, because the company is buying. And it's a limited company, so you always pay the extra amount of stamp duty as well, as if it was a second property, so lots of stamp duty probably. And mortgage fees, of course. It's the company, it's not you, it's a separate entity, it will need a new mortgage, and new mortgages pretty much always come with fees these days. So just moving your investment property to a company is quite an expensive process, likely costing tens of thousands of pounds. And these all need paying straight away, or very soon anyway. In the case of capital gains tax, you get a month or so, a couple of months. And you've got to have that money on hand to cover all of those sort of bulky expenses. Even if it is helping cash flow on a month-to-month basis, you can't use that to pay all of these costs. So is all this expense and hassle worth it? Well, next week, I will work through an example, or maybe two, depending on how time goes, so we can find out for sure. But generally speaking, it can be in some situations, especially if you're looking at it as a very long-term situation, a long-term investment, a long-term consideration for the revenue and the income that you will get back from. I will just mention a couple of situations where it almost certainly is not worth it, though. If you only pay tax at 20%, the Section 24 tax credit, which is at 20%, probably mitigates things in this situation, assuming you stay in that tax bracket. And there's lots of probablys and assumings and things of what I've just said, and that's because the way that tax credit works is not simple, or certainly not as simple as it would be nice for it to be. So yeah, you would still need to double check things on that. The other sort of obvious situation, though, is if you don't have a mortgage on your property. You'll be paying roughly the same amount of tax because, of course, you've got no expenses, no mortgage expenses to worry about there. But because you don't have those mortgage expenses to pay, you'll actually have the profit to cover the higher amount of tax from the higher income. And if you're not losing out to Section 24, then owning property in a company is probably of no benefit to you. Companies cost money to run. They still pay tax. And if you want to take the money out of the company to actually spend it on a month-to-month basis, then you'll be paying tax on that again as you extract it from the company. So it probably may well not work out any better to move the property or properties into a company. Of course, if you currently have them without a mortgage and you're thinking about mortgaging them in order to raise new funds or whatever it might be, or you're looking to expand, then maybe there are situations where it might still make sense. But if you're holding property in your personal name without a mortgage and you're planning to keep it that way, you probably want to keep them in your personal name, probably. Just before I finish, I know there are some approaches that claim to avoid or reduce the capital gains tax and or the stamp duty in this property moving process. However, they seem to carry dangers. HMRC are actively pursuing people who followed at least some of these schemes, and they are now asking for all of the missing tax back, despite the fact that these transactions happened years ago, and these people probably paid thousands, if not tens of thousands, in fees to companies who sold them this sort of plan and approach to avoid paying the tax. So, yeah, there's a danger there. Beware. So, if you're struggling to have any money left after your mortgage interest and tax bill from your existing rental properties that you own in personal names, come back next week for a worked example of the costs and results. I will look at what the property is making before and after transition into a limited company, following the official moving process to sell a property and buy that property into a limited company. And of course, please remember, this is a podcast. It is most definitely not financial advice. Thank you for listening, and I look forward to speaking to you again next time.